All right, time to settle the age-old question. I really had no idea how much of an issue this was, and that's why I'm making this video right now. Show you the truth about how mortgage inquiries work, how inquiries work on a credit report. And you don't just have to take my word for it. I'm not just going to tell you what I think, what I know through decades of looking at credit reports. I'm going to show you what some people who have a lot of clout also have to say about this recently. As we've seen, some things can change when it comes to credit, and things do change frequently, in fact. So let's take a look at Exhibit A. Let's start with, I'm going to share my screen with you here. Let's start with this. So Jennifer White. And if you feel like reading up on Jennifer White, you can. This is obviously on Experian.com. And you can see here, this is the Experian consumer-facing portal. Jennifer works there. She's been there for a long time. She's got a lot of experience. She responds to people's questions there. She blogs for them, so on and so forth. Well, let's look back at a blog that she wrote. And this is in September of 2019, late September 2019. So this is just a few months old from here. Let's say 6 months, a little more than that, maybe 7, 8 months old. This is something that I've known to be true for a long time. However, the credit bureaus haven't been really out in the forefront as far as putting this information out there. There's a lot of reasons for that, which I'm not going to go into in this video. But she's essentially responding to a question here from someone named TKB. This person says, hey, I pay everything on time, but my credit score is still low. Mortgage inquiries are hurting me. What can I do? A lot of people are hesitant to have their credit run when it comes to applying for a mortgage because they believe that there's something there that's going to hurt their score. So if I run it today, I'll wait until we need it the last second, and then I'll run it because I don't want it to hurt me. And if we have to run it again, then I'll get hurt again. All of that is not true. And I'm going to show you exactly what this means. So you can see here when she responds, and by the way, I'm going to link this particular link right here in this video so you can read this whole thing if you want to. But basically what she says, she gives some background. She said, okay, here's how credit works. Here's credit risk score factor. She's putting all of the keywords that they're trying to get for SEO here in this blog. And then she actually gets to where she starts responding to this question. And she starts off with a headline in bold: inquiries have only a small impact on credit scores. She says a small impact. Well, that's still some impact, Derek. Hey, you told me, running my mortgage report isn't going to hurt my scores. Hold up for a second. She talks about credit inquiries in general. She means in general, they only have a small impact. Let's look at what she says when we talk about specifically shopping for a mortgage, and then I'll tell you my 2 cents. So she says, and I quote, when shopping for a mortgage or a car loan, both happen to be the case, you may notice that multiple lenders have access to your credit report as a result of just one application. That happens because a lot of companies, finance companies, broker out things, or they'll shop your profile with different entities, investors, and so forth. However, she continues, as long as those inquiries occur within a certain period of time, usually 14 to 30 days, most credit scoring models will count them as just one inquiry. So you get one inquiry. One inquiry does not really hurt your score. If you could have even 3 or 4 inquiries in the past few months. If you've only had those 3 or 4 in the past year, you won't see any impact on your score. It's really only once you get over 4 and they're recent and they're not being attached to new credit. And I'll explain why in just a second. Here's what she says, and this is what we need to pay the most attention to. And if I had a way to highlight it, I would. She says the newest scoring systems from FICO and VantageScore, those are the 2 main ones that people are using, the apps are using, the things that are being used for cars, things that are being used for mortgage. These scoring models will omit the inquiries for mortgage applications. Omit them, meaning if you're applying for a mortgage, they won't even account it. They won't even look at it. Now, you might say, well, wait a minute. And then she goes on to say, this means you can shop around for the best rates and terms of your loan without being penalized. And that's a great advantage to have as a consumer. You might be saying, well, Derek, why would you do that? Why are you encouraging people to shop around on you, your mortgage lender? I mean, whatever. That's not what I'm doing. I'm just telling you the truth. This is how this works. So, the bottom line is, what I've noticed is that we are not seeing any impact to a mortgage inquiry at all. And she's kind of got our back here because she's saying, hey, listen, the newest scoring systems, and by the way, this is late September of 2019. So we're 7, 8 months later. So not very old as far as on the internet blog articles are concerned, but pretty recent. And she's saying the newer systems are omitting, says the word, omit the inquiries for mortgage applications. Omit, meaning we're looking past it. We don't care. Why? Why would this be the case? Why is it that they're omitting mortgage application inquiries from the calculation of your credit score? Well, let's think about it for a second. What is the purpose of the credit scoring model. The credit scoring model is designed to help try to figure out who is going to default in the future. Now, some of that is weighted upon who has defaulted in the past. If you've defaulted in the past, especially the recent past, then the chances are increased in their mind that you would be able to, then default again here in the near future. However, in predicting that, what they have noticed, and what seems to be just common sense, is that if you're applying for a mortgage, that is not really a sign that you are in dire financial circumstances. Okay. Typically, people who are applying for a mortgage are people who are doing well. People start talking about buying a house when things are going well. Hey, I got the new promotion at the job. Hey, look, our savings account is swelling up. Hey, look, we're thinking about having a family now, having a baby. We've saved up some money. We've been doing a good job with our finances. Let's go and apply for a mortgage. That's usually what happens before people buy a house. So that's not really a time in which the scoring model believes that they are a risk. And so that is why you're going to see the new systems, both for FICO and VantageScore, the two biggest ones, that's pretty much all of them, especially from a mortgage standpoint, they're going to omit mortgage inquiries altogether. So not only is there no damage, and I've got multiple situations in which I can prove this, in which people have pulled credit at another lender, come to me after that, weeks after that, months after that, I pulled and got the exact same 3 scores. So, I've got tons of proof of this. This isn't a theory. I've known this for decades. It's been the same way for a long time, but they didn't omit it in the past. That is something that's new, but it makes sense. In the past, it was just counted as one inquiry, and one inquiry does not really do much damage to your credit. Inquiries do damage to your credit when you're running around getting credit card inquiries, when you're getting personal loan inquiries, and then you're not getting any credit associated with that inquiry. So when you inquire with an institution, then you achieve no credit with that institution. The credit scoring model is aware of that. Okay, and that's considered to be more risky. If I'm running around applying for all these loans, but I'm not getting any loans, then the credit scoring model says, this person is probably in a desperate situation. They are probably more likely to default on a new loan than someone who isn't doing this. So we're going to hit their score for these inquiries because they believe that you're in bad shape and that you're running around trying to find a solution. When you are going out and getting a mortgage inquiry, you're not doing that. So it makes sense. So inquiries can affect your score. And a lot of people have those as a reason code as to why their scores are lower than they should be. But it's not the mortgage inquiries that's doing it. And moving forward, the mortgage inquiries won't have any impact at all, as mentioned there on Experian.com. I will link that article both in the YouTube and in the Facebook post here in case you want to read it, in case you want to check her out. Check out Jennifer, see what's up with her. She's got a long history in this. She is technically an insider. And when I find information like this buried on these sites, I think it's really important to look at, because when you do a Google search for does a mortgage inquiry affect my credit score, you're getting stuff that's 7 years old, 8 years old, 10 years old. You're getting all this crap that's probably not true. You have to look for recent information, and you also have to think about logically, how does this work? How does this help the credit agency's client? Who is the credit agency's client? Do you pay money to the credit agency? Maybe you do. Maybe you do to monitor your credit through the app. Those apps all suck, by the way, and they're all wrong. But if you do, and you're a customer, you're a rare individual. Most people are not customers of the credit bureaus, although the credit bureaus are trying to go consumer direct. The biggest customer for the credit bureaus is the banks. And so they're looking out for the banks. They want to make sure that the bank is protected. They want to make sure that the default rates that they've promised the banks based on these credit scoring models are accurate. And in order to do that, they need to tilt them a little bit this way, right? They want to see your scores be a little bit lower. They'd like you to be a 658 if you're really a 671. Why? Because the tier's structured at 660. And so now you fall into a lower tier. So their model gives them more leeway in case you default, for them to say, hey, look, our numbers panned out. Because the biggest banks are making lending decisions based on these algorithms. A lot of the pricing that's going on in mortgages, this isn't just in mortgages, but credit cards, all lending is based on the models that the credit bureaus are giving to them. So they're giving the models saying, hey, people with this credit score will default on a car loan 1 in 1,000 times. People with this credit score will default on a car loan 1 in 300 times. That's a lot of pressure on the credit bureaus. So you can see why they might want to skew. They want to make it a little bit more difficult for you to have a higher credit score, because it ultimately helps make them look good. If they're able to say, hey, 1 in 1,000 people with this credit score are going to default, and 1 in 2,000 people actually end up defaulting, the bank's going to be very happy with them, because based on the risk-based pricing the bank has created, they're very profitable in that situation. So just keep that in mind with credit bureaus, how credit works, how lending works. And no, your mortgage inquiry is not going to hurt your credit score. I promise you, your mortgage inquiry is not going to hurt your credit score. It's not going to help your credit score either, but it's not going to hurt your credit score. And you don't have to take my word for it. I provide you the evidence right here. So hopefully that's helpful. Share this. I know my mortgage friends are going to share this. Share this with your friends. Let's help make them smarter than everybody else. Thanks, guys.